Welcome. In this clip, we discuss investments, savings, and the market for loanable funds. The two key concepts we use in this clip are investments and savings. Let us look at investments first. Investment is an asset that is acquired in order to generate income in the future. In other words, investments will be added to the current stock of capital, and this will include machines and equipment, but investment may also be added to other assets, other factors of production. For example, you can invest in land, natural resources, or acquiring more human capital. In the model we discuss, we make an assumption that the economy is a pure market economy, which means that investment is only made by the firms. So we will assume that governments do not invest. Of course, assuming that governments may also invest could make a model more lifelike, but it would introduce complications unnecessarily. Savings are nothing else than what remains of your income after being used for consumption. That is, it equals the consumption which did not happen, or it is a foregone consumption. So simply, on national level, you could say that savings is nothing else than the difference between the aggregate income and the consumption by the households or the expenditure by the government. Both households and governments can have savings, or they can also pile up debt, which is negative saving. The savings made by households we will refer to as private savings, while the savings by governments are called public savings. We start with a short historical review of the development of the market for loanable funds. Before we start it is a good idea to define what I mean by market for loanable funds. The market for loanable funds is that market where the demand for loanable funds, that is investment demand, encounters the supply of loanable funds, that is savings. In the older societies, in other words, in pre-industrial societies, investments were mostly done by someone using their own savings. So individuals, if it was possible, and very often it was not possible, but still some fortunate individuals could save a part of their income for a longer period, and maybe they could use it to buy some additional land, and that would be an investment. Of course, bigger investment projects were also undertaken, but no individual had enough resources to finance such endeavors. As a result, these were carried out by the government. And an example could be, for example, the canal system in ancient Mesopotamia, or very often all kind of buildings to store food. As a result, private investments were quite limited in this period. Slowly, however, somewhere during the first millennium BCE, the monetary part of the economy started to increase, and some people had to make larger investments. For example, those who had larger landholdings, estates, may needed some external resources to acquire further units of land, further estates. So this was the period when some of the investors, so some of the firms, if you like, entrepreneurs, started to borrow from those who had the means. So there were some wealthy people who lent money to these individuals. Later, in the Middle Ages, even certain bank houses came into existence which offered such loans. Of course, the problem was that the total amount of such loans was available and limited to the elite of the society. There were also no general and obvious regulations of such businesses, and there was society-wise a lack of information, so many people could just not have access to the loanable funds. The next step is the early modern period in Europe. This is the period which we also refer to as the period of merchant capitalism, which was the early form of capitalism. We call it merchant capitalism because most of the investments were channeled into the long-distance trade business. Long-distance trade was a very expensive and very risky business. First of all, ships were extremely expensive to build and maintain, but also many of the ships which were sent out for expeditions never returned. So, because there was an increased demand for investments, the available resources were not enough. So some companies came up with the idea of selling a partial ownership in their company in exchange for loanable funds. So the first stocks appeared, and these stocks and later the securities, which did not represent any ownership but were basically just lendings to a company, so these securities and stocks were traded in the stock exchange or bourse. The first company who issued stocks was the Dutch East Indian Company, and you can see on the screen the copy of this first stock from 1606. Now, these new loans were sufficient to finance merchant capitalism, but necessarily it was limited only to the wealthy who had access to stock exchanges and had enough savings so that they could buy stocks and securities. As the Industrial Revolution started, the required amount of investment skyrocketed. The Industrial Revolution transformed Europe. During this period, not only new plants and manufacturing capacities were built, but also a lot of modern infrastructure, including road networks, new canals, and, of course, railway. Now, these were partly financed by the state, so simply the state used some of the tax revenues to finance the build-up of this new infrastructure. But this could not have happened without private investments. The problem is that stock exchanges could not finance the Industrial Revolution. What was needed is to somehow channel the savings of the poor in the society into the system of loanable funds, or in other words, into the market of loanable funds. And this required intermediaries, certain financial institutions who collected the savings of the poor, and they lent these assets to companies. Now, such institutions were first the commercial banks, but at the same time there were also other forms of financial intermediaries like building societies or mutual saving banks. And even for the poorest, it was possible to have some savings without even having a bank account, and this was done by the postal saving system. Now, with this new evolution in the financial system, we basically arrived to the modern market for loanable funds. And now we turn our attention to the technicalities. So we assume a closed economy. Let us look at the savings first. Savings equal that part of the income which was not used for consumption. So we can then define the private savings, that is, savings by the households. Now these must be equal to the total income minus the tax, which is paid to the government, and minus the private consumption expenditure. So simply, private savings are nothing else than what remains from your disposable income, and disposable income is nothing else than your net after-tax income after consumption. For the form of the curves in the loanable funds market, it is also important to see that here private savings basically depend only on income, but they do not depend on interest rate, because we assume in this very simple model that consumption does not depend on interest rate. Of course, this is again a simplification, because we all know very well that consumption decisions will depend on interest rate. If you could have a very large interest on your savings, then maybe you will be more inclined to reduce your consumption after all and save more. Now the public savings is the other component of savings. This is done by the government, and actually all those tax revenues which were not spent, that is, were not part of the public spendings, will be public savings. And this public savings is actually nothing else than the primary budget balance of the government. So simply tax revenue minus the government spendings. If you add up these two, you get the so-called national savings. And as you can see, because we assume that taxes do not depend on income, so we have specific tax in the society, or some kind of lump sum tax. For this reason, you will see that tax drops out. This is again something which is not very realistic, but we are using here really the simplest possible model, and at further stages of your studies you can of course make this model more complex. So finally what we get is that national savings must equal the aggregate income minus the consumption expenditure and minus the public expenditure. The next step is to look at investments and the equilibrium in this closed economy. As we already learned, the GDP can also be defined as the sum of all expenditures in the economy. So that is what we expressed as y equals c plus I plus g. This is a very important identity for a closed economy. So the total expenditure, which is also the total income, as we already saw that, or we can call it GDP, will be nothing else than the sum of the private consumption expenditure, so the spendings by the household, the total investments, and the spending by the government. What we have to do is to bring these two identities together, because in the previous slide we just saw that savings are nothing else than total income minus the private and the public expenditure on consumption. And that gives us then a relationship between the two, because using the expenditure approach to GDP, which is here denoted by number 1, you can see that you will get that the total investment in the economy must also be equal to y minus consumption by the households minus public spendings. This means that our economy in equilibrium will have a very interesting situation, namely that the total savings and the total investment demand is equal. And please remember this is the equilibrium condition in the goods market for a closed economy. It is a very general mistake, however, to confuse the real side of the economy, that is the market for goods and services, or the market for loanable funds, with the money market. What we discussed here is not money. You could have observed already that I didn't use the word money in a single, ever in the first part of this clip. And there is a reason for that. Money is a way to measure the value of your assets, for example, or you can use the currency unit as some kind of measure of value, prices, and wages in the economy. But here we talk about actual assets, not being used up in the consumption, but rather being used up in expanding the production. I know this is difficult to do if you are just starting to study economics, but this thinking in the duality will be rewarded later when we look into the ISLM system. So just remember that this is not money. This is simply about the use of the total assets in the economy. Now we are in the position to draw a very simple graph for the market of loanable funds. So we have here two sides, a demand side, which is the investment demand, and the supply side, which are the savings. It is usual to depict this system with interest rate being on the vertical axis and investments and savings being on the horizontal axis. We start with the investment demand. This is the green negatively sloped line on the graph. Investments will depend negatively on the interest rate. Why is this? Now, what is interest rate? Interest rate, in this case, is nothing else than the price of investments. So when interest rate is high, that means investments are quite expensive. So you will find it profitable as a firm only to do investments if the returns to that investments, the profitability of that investment is very high. But there are just very few opportunities to have a very large economic return on your investments. So necessarily when investments are very expensive, then only the best investment opportunities will be actually realized. As the interest rate, the price of investments is reducing, more and more less profitable or maybe riskier investment opportunities will become viable, and so total investments will increase in the economy. Sometimes you may even hear that interest rate is actually also some kind of quality filter for investments. In an economy where interest rate is very small, then even very risky and very low quality investments will look profitable. On the other hand, when interest rate goes up, then the investors, the firms, will be very, very careful in the choice of future investments. The next step is the savings. Very important that, as I already told you, the savings in this simple model will not depend on interest rate. So basically, it will just be a vertical line in this market. And as you can see, investments and savings are equal at a certain interest rate, which is denoted here as I star. This is the equilibrium interest rate in the economy. And the equilibrium in the market for goods and services, which could be seen as the real side of the economy, is actually governed by adjustment through the interest rate. So what you saw in microeconomics, that it was the price that finally made sure, so changes in the price made sure that the equilibrium was restored. Economy-wise, it is going to be the interest rate that adjusts so that the equilibrium is re-established.